Hello, international finance students. We're now in week 5, so we're moving along quite quickly here. It's hard to believe there's only 2 weeks left, but just stay on top of everything. This week we go a little bit lighter. We just have chapters 13 and 14. It gets lighter next week too with chapters 15 and 16. So just jump into those forum discussions early. Make sure you get your quiz completed and get your homework submitted. So, as I said, just 14 more days, so just stay on top of things. You'll do fine. So this week, looking at chapter 13, I kind of have some notes here I wanted to review. Talk about the global cost and availability of capital. Ultimately the goal is, that if I'm trying to raise financing, we think of capital, just basically think of monies. I want to do this at the lowest possible cost. And in this chapter, it should be a little bit of a refresher from your finance course because they're going to talk about things like the capital asset pricing model, the weighted average cost of capital, the after-tax cost of debt. And a lot of what this chapter goes on to assume is that we do have efficient markets in the international markets just as we would in the domestic market in the United States, that there's liquidity. But sometimes there can be some factors that can cause raising capital a little bit more difficult. Some of the things they mention about foreign exchange risks, lack of transparency, political risk, all these different things about insider trading information. So we have to be cautious when we're investing in these markets to think that truly I'm going to get a lower cost of capital. Also, too, it talks a little bit about portfolio theory, the idea that if I have a diversified portfolio theory or international investors are looking to diversify, I can actually hopefully overall reduce the overall risk of that portfolio. We think about things about standard deviations of returns and associated betas. How does the portfolio move in relationships to some markets? So in the textbook, they go through some examples that says in theory that I could actually lower my weighted average cost of capital or capital asset pricing model, whatever my required return on equity by diversifying internationally. But the authors are cautious to say this may not always be the case. So they also point out that with returns, as we've stated in previous weeks, that foreign exchange risk, that if I'm doing some type of investment in an international portfolio, I could also gain if the stock price goes up, but I could also gain if the currency is appreciating value. So if the yen goes up in value, I convert it to dollars, it could be a return. Just the opposite can happen too. If the currency depreciates in value, then it can actually hurt my returns in that portfolio. All right, those are some examples I want to point out in chapter 13. Chapter 14, we now go to how do firms actually go out and raise this capital. And some may be done privately, other methods might be done through investment bankers. And that's what the chapter kind of starts out about. Talks a little bit about the idea again about what is the proper amount of equity and debt. As would be expected, as I increase my debt ratio, I can get some benefits of that because with the tax write-off from the interest expense, it can lower my after-tax cost of debt. But as I start to take on more debt, the firm can become distressed, especially if cash flows are rare, and that can really increase my opportunity cost. So there's a trade-off. What's the right balance of debt and equity? Some other things they talk about the optimal financial structure, about how much of debt and equity. Some of the factors could be the availability of capital in those markets, diversification of cash flows. Do I have operations in other countries that can help with that? Obviously, the foreign exchange risk and the cost of debt can be a factor. And then the expectations of the international portfolio investors. What type of risk are they willing to take on? Okay. So raising some equity globally, they talk about the IPO, the initial public offering, the euro currency issues, and directed public-private issues. With that, they also go into what were called depository receipts. In particular, they talk a lot about the ADRs, that if I wanted to get listed on an American exchange. So there's different things such as pink sheets, or that I just list the securities, or I'm actually issuing an IPO. But it allows different investors to get invested in foreign securities, and you kind of get around a little bit of the SEC regulations. Just last thing to just mention with private placements, we'll wrap up with this chapter, is that private placements can be very beneficial because it can help reduce the flotation cost, the expense of issuing an IPO. If I already know that I have a set buyers out there. It could be like an insurance company or a pension fund that I can directly go to. I can avoid that middleman and reduce some of those costs. So they mentioned that towards the end of the chapter there. And the last thing, just wrap up, is that international firms do go out and try to raise debt internationally. Again, they're going to have it through maybe perhaps bank loans, euro notes, which is a form of borrowing, or it could be international bonds. So, well, that's a wrap up for this week. But do send me an email if you have any questions. But I look forward to talking to you online, and have a great week.